Welcome to the Chapter 2 lecture series, Accounting for Business Transactions. Our first learning objective explain the steps in processing transactions and the role of source documents. Business transactions and events are starting points of financial statement. Process to get from transactions to and events to financial statements include the following. You first identify each transaction and event from source documents. Analyze each transaction and event using accounting equation. Record relevant transactions and event in a journal. Post information into ledger accounts. Prepare and analyze trial balance financial statements. Please understand, when we are doing the identify from the source documents, we are looking for items that involve money. Source documents identify and describe transactions and events entering into the accounting system. They can either be hard copy or electronic form. Examples are sales tickets, checks, purchase orders, bills from suppliers, employee earning statements, and bank statements. Source documents, especially if they're obtained from the outside organization, provide objective and reliable evidence about transactions and events and their amounts. Describe an account and its use in recording transactions. An account is a record of increases and decreases in a specific asset, liability, equity, revenue, or expense. The general ledger is a record of all accounts used by the company. Recall in basic accounting equation. Assets are equal to liabilities plus equity. The equity section is composed of the owner's capital account, the owner's withdraw account, as well as revenues and expenses. Asset accounts, assets or resources owned and controlled by a company that have expected future benefits. Most accounting systems include, at a minimum, separate accounts for the assets to cash, accounts receivable, notes receivable, and prepaid accounts. Liability accounts are claims by our creditors against assets, which means they are obligations to transfer assets or provide products or services to other entities. Creditors often use a balance sheet to help decide whether to loan money to a company. A loan is less risky if the borrower's liabilities are small in comparison to assets, because this means there are more resources than claims. Equity accounts. The owner's claim on company assets is called equity, stockholders' equity, shareholders' equity. Equity is the owner's residual interest in the assets of a business after deducting liabilities. I always like to think of equity as the part of the assets that is free and clear of debt for the company. Here's a list of common assets accounts we're likely to find in all businesses. Cash. It reflects companies' cash balances. It includes money, any funds that a bank accepts for deposits, coins, checks, money orders, and checking account balances. Accounts receivable are held by the seller and refer to promises of payment from the customers to the seller. These transactions are often called credit sales, sales on account, or sales on credit. Prepaid accounts, also called prepaid expenses, are assets that represent prepayments of future expenses. I have paid in advance. Expenses expected to be incurred in one or more future accounting periods. When the expenses are later incurred, the amounts of the prepaid are then transferred to the expense accounts. Examples include prepaid insurance, prepaid rent, and prepaid services. Liabilities are claims by creditors against assets, which means they are obligations to transfer assets or provide products or services to others. Creditors are individuals and organizations that have rights to receive payments from a company. This is a listing of the common accounts we are likely to see in a general ledger. An unearned revenue is one in which the cash has been received, but the product or service has not yet been delivered. If you subscribe to a magazine, you generally pay a one-year subscription in advance. For the publishing company, cash is received, but nothing has been done to earn the revenue. As the magazine is delivered to you, the publishing company recognizes the portion of the money received as revenue. At the end of the year, all the revenue will be earned and the liability will no longer exist. The owner's claim on a company's assets is called equity, stockholders' equity, or shareholders' equity. Equity is the owner's residual interest in the assets of a business. Equity is impacted by four types of accounts: common stock, dividends, revenues, and expenses. Owner's investments increase both assets and equity. Increase to equity is recorded in an account called common stock. Any owner investments are recorded in this account. Do you remember the expanding accounting equation? We used it to record transactions in Chapter 1. Remember that revenues increase the equity side of the equation and expenses decrease equity. In addition, common stock increases equity and dividends decrease equity. Describe a ledger and chart of accounts. The ledger is a collection of all accounts and their balances for an accounting system. Company size and diversity of operations affect the number of accounts needed. Chart of accounts is a listing of all accounts in the ledger, and each account includes an identifying number. Notice that all asset accounts begin with an account number of 1, liabilities of a 2, equities of 3, revenues of 4, and expenses of 6. Now we're going to go back and see what you've retained. Classify each of the following as an asset, a liability, or an equity. There are some words to look for in account titles to be able to determine the type involved. Prepaid is always an asset. So the account has the word prepaid in it, you know it's always an asset. If it says receivable, it's always an asset. Remember, a prepaid is I paid something in advance. Receivable means I've given people credit, they're going to pay me later. A payable is always a liability. That means I owe someone for something I have received. An unearned is a liability. This is when I've received money before I have contracted the services requested. So prepaid rent, I'm going to go through these first and answer them, and then I'll show you the answers. That way, if you want to take a minute and try and quiz yourself on this, you don't have them all in front of you. Prepaid rent would be an asset. Common stock falls under the equity. Notes receivable, asset. Accounts payable, liability. Accounts receivable, asset. Equipment, asset. Interest payable, liability. Unearned revenue, liability. Land, an asset. Prepaid insurance, an asset. Wages payable, a liability. And rent payable, a liability. This is the end of our first section. I will look forward to seeing you in part 2. Thank you.